Hello and welcome to SwitzerTV Investing. I'm Peter Switzer. On tonight's show, we hear from the CEO of JB Hi-Fi, Richard Murray, on why his company has shot the lights out and why it should keep on doing so in the future. Then I catch up with the MD of Webjet, Zhong, who tells us what is critical to make his company fly high in 2021. I asked news.com.au's Terry McCann why he thinks the recession is not really done and dusted. RMIT's Professor Angel Zhong tells us how to trade the US election and to underline some stocks that really, or some sectors that you really should think about no matter who wins the election. And Julia Lee gives us her take on the companies that she likes or dislikes right now. But before all that, let's look to something far more important, the winner of the Melbourne Cup. And each year, Tom Waterhouse gives us his and his father's tips for the big race. And he has a pretty good strike rate. Well, I'm catching up with Tom Waterhouse as I do every day before the Melbourne Cup, and it's good to see you, Tom.
Good to see you too, Peter.
A couple of years ago, we went to the Call of the Card, and I brought my camera guy with me, Andre, and we had an interesting time, but that was all in the Crown Casino Hotel, and of course, that kind of thing can't go on anymore. How have they done the Call of the Card this year?
There's no Call of the Card, which is so sad. It's first year since 2008 I haven't been there, and it's such a great event because you can back these horses to win $1 million or a couple of $1 million. So it's a huge betting event, and to not have it on today, well, yeah, this is the first cup I'll be going into without a significant wager on it. So
okay, well, it is quite sad for you and the industry. So despite all that, both you and your father Robbie would have done the form on the horses, and I know you always say your old man's a very good assessor of horse flesh. What is he and what are you seeing as the best chances to win the Cup tomorrow?
Yeah, well, he's a genius. He's been a professional punter obviously for over 40 years, and all of the ways that he views racing, I've just tried to be a sponge and learn as much as possible. And he always talks about with the Cup that he sort of wants to find a horse that's got the European or UK or Japanese breeding, wants them to have had at least one start here in Australia, have won at their last start, and wants them to be an N-type. Obviously doesn't want them to be gelded or to be a mare. So if you take those factors into account, it really, there's one standout, and that's Sir Dragonet. And that Cox plate form I thought was very strong also. And it was dominant in that race. Glenn Boss on board, and I thought that it's around $11 at the moment. I thought that it was huge value in the race, and the other horse, Russian Camelot, it comes out of the Cox plate as well, and I think at $14 it represents value. So I think those two runners are the ones to watch. But yeah, you try and find horses that have the factors that show good return over the long term, and that doesn't mean other horses can't win. You just, over the long period of over many years, you want to find those type of horses, and I think Sir Dragonet really fits the profile in the race tomorrow.
The horse at the top, it's called is it Anthony Van Dyke? Yeah. Obviously it's a very good horse, but the weight looks surprisingly heavy. Can a horse win with a heavy weight nowadays? It always seems to be much lighter weight horses win the Melbourne Cup.
Yeah, look, we've got it marked around $14. Of course it can win because there's so many factors that come into play on the day in terms of the wind, the track conditions, the run of the race, the speed, like interference. We've got it marked slightly longer than what it is at the moment, but it doesn't mean that it can't win. I just don't have it as one to back.
Yeah, it just seemed to me, as a complete amateur in the game, it beat a horse called Stradivarius, which is an extraordinary horse over in UK and Europe, isn't it?
Oh, incredible! It's I remember going over watching the horse. It just gapped them when I was over there in the UK, and it's come out and won many times since. It's a top-notch horse, but this is a different this is the speed in this race. They run this not like a true staying test in some circumstances. Tomorrow's going to be a dry track. Yeah, look, all horses can win the race. You've seen that with the 100-to-1 shot winning a couple of years ago. It can happen. It's just you've got to try and find the value in the group of horses that you want to be on, and view it as over the next 10, 20 years, 30 years betting on the Cup. I hope I come out a long way in front, but each year there's a lot of luck that comes into it on a year by year basis.
Okay. On the subject of luck, you guys now have a gambling fund. So, and it is for sophisticated investors. That's where we should make the point. Tell us about the fund itself. What does it try to do?
Look, we had a lot of members that were following my tips for the last few years, and they kept asking me, what do you like in the gambling space? Obviously, we've seen the huge growth of companies like PointsBet and BetMakers in Australia. And I've my whole investing life just focused on the gambling sector, the area that my dad and my grandfather and great-grandfather have been in, and I've been in, and that's all I live and breathe. And so when I was going actually into a business called BetMakers, they were a couple of years ago, I thought, well, I'm going into this business. Maybe a few of the platinum members wanted to come in with me, and to get them to come in, I had to set up a unit trust and then get an Australian Financial Services license and all these requirements. And I thought, well, if I'm going to be investing in listed gambling companies, maybe there's appetite for other wholesale investors to come in with me. And we started up about a year and a half ago, and it's been going well. Really, the sector's been very lucky in a sense in that it's very robust, the gambling sector, in all times, but especially in tougher times. It seems it's historically been very robust. But what's exciting about the space with the opening up of the US, it's a real growth period for the gambling sector. So it's a once in a 100-year or 200-year period. You've got the biggest economic nation in the world in the US opening up state by state over the last 2 years. And I think that will continue. It's probably a 10-year journey of the states opening up. And every time one opens up, it's like a mini Australia. And so I've really just tried to focus on the area that I feel that I've got an advantage in. And that's the space of the business-to-business providers, the B2B providers, those that are providing the services to the gambling companies. Having run William Hill out here for 4+ years, I got to see a lot of these companies, the middleware companies that provide the pricing services or the gaming product or the CRM product or whatever these big companies need to run, and have really just tried to focus on that and stick to the industry that I know.
Yeah. How many investments would be in the fund?
We've got at the moment around 10, but three main ones. Our three main ones in the gambling sector are BetMakers, which is a really interesting business. It provides all the fixed odds pricing data to all the bookmakers for racing in Australia and the UK, and just opening up, got a license to do it in New Jersey at the moment. And it also provides all the integrity data and pricing for the racing bodies. So it's sort of this player in the middle of the racing industry from a fixed odds point of view, needs this provider, and the bookies need the provider. So it's an interesting business. And then we have investment in Flutter, which owns SportsBet here in Australia, and owns FanDuel, which has got a large foothold in the US. It bought the fantasy gaming business FanDuel, which has over 8 million accounts, online accounts in the US, and has got large market share, close to 50% market share already in New Jersey, and huge marketing budget and large team of people there to really put their foot down in the US market. And then we're in a business called Playtech, which is provides gaming services and all the gaming and gambling services to both land-based and online providers, and it's also just kicked off its expansion in the US. So I think it's a really interesting space, and a space that is always been good growth. Like the gambling sectors, you look at those big UK providers in a mature market, they've been growing, the big ones at sort of 15 to 25% year on year. But you're seeing this very exciting period now because the US is just such an untapped market.
Yeah. Are any of those companies you mentioned listed companies?
We're only in listed companies at the moment.
Okay.
It doesn't mean we're not looking at companies that aren't listed. We're looking at a company called SimpleBet in the US at the moment, and it's not listed. It plans to list, but it provides all of the in-play pricing data for micro markets. And it's not listed at the moment, and we haven't invested in it yet, but it's all the companies we're in at the moment are listed.
Okay, Tom. Well, thanks for joining us. Good luck with that. And we hope your tips win tomorrow as well.
Yeah. Thank you very much. Have a great day.
Same to you, Tom.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Joining me now is Julia Lee from Berman Invest. Hi, Julia.
Hi, Pete. How are you doing?
Very good, very good. Let me just throw a few at you. This has come up from our Boom, Doom and Zoom show. And whenever I can't answer a question, I say, I'll get Julia to answer that one. PPE, People's Infrastructure. What kind of a name is that? It sounds like something straight out of Beijing, doesn't it?
Yeah, I mean, this is a company, I think, that looks mainly at contractors, so flexible working staff. And I just think that with the budget implications, that it's probably more supportive of full-time staff or more permanent staff rather than contractors. So, look, I'm probably just on the sidelines with People Infrastructure. Despite their last result, they saw growth of about 34%, which is pretty impressive. I just think there's an incentive now to hire a younger workforce and a more permanent workforce, given that the government will pay up to $100 a week for hiring someone 18 to 35 years old who was previously unemployed.
Yep. Now, what about URW, Unibail Rodamco? It's the old Westfields business, isn't it? Like, what's your outlook for these guys?
Look, this is a really hard one. It's been so volatile. They own shopping centres all over Europe as well as the UK and the US. The US and the UK assets they picked up as a roll-up of the Westfield brand into this particular company, but they are the largest shopping mall operator in continental Europe. So they're absolutely huge in Europe. Now, what's happening in Europe at the moment is that France is in a 4-week lockdown. Germany is in a lockdown till the 1st of December. And these things are going to have a bad impact in terms of foot traffic and physical shopping malls and offices, which Unibail is involved in. So the short-term outlook isn't looking great. So then you have to ask yourself, well, what's the medium and the long-term outlook looking like? And look, at the end of the day, this is a landlord. And unfortunately, the outlook for rent isn't looking great as well. The fact that we have seen a massive acceleration in the structural demand for digitalization and online sales means that there's not going to be as high a premium put on physical stores. And that doesn't bode well for renegotiations of rent as well as new rentals coming through. So look, I think the outlook is soft, despite there being quite substantial value there. And you are looking at this as a value play if you get involved. But look, I think it's a pretty tough one, given that the outlook for rents is also declining.
Totally agree. Strategic Elements, that's SOR.
Strategic Elements. I don't actually follow this one, but I do know it's involved in rare earths and we're involved in Linus. And the reason why we like the rare earth space is because the tensions with China have been escalating. Now, China's still responsible for about 85% of the world's rare earths. And rare earths relate to 17 different elements, and they're used in everything from military equipment, defense missiles, to our laptops, batteries. So there's virtually nothing that's quite technical that can be done without rare earths. So it is a very strategic asset, and one that a lot of areas now and countries are looking at as a strategic asset. So the US is the latest, where they're looking to fund as well as build a processing unit in Texas for military equipment. And Lynas is looking to be the developer of that. So Lynas, I think, is in a good seat. It has the biggest rare earth deposit outside of China. So it's the biggest producer outside of China because of its Mount Weld asset in WA. If you are looking at something smaller like SOR, this is more of an explorer. So when you're looking at an explorer versus a producer, the dynamics are a little bit different. So it is on the basis of the quality of their assets as well as the exploration results that you'd be looking at. And there's higher potential upside, but higher potential downside if things don't go right as well. So I think the rare earth space is an exciting place to be, especially given that not only a lot of big tech firms, but also places like the US and now Europe are looking to diversify their supply of rare earths because of the tensions of China, and China's still dominating this area.
Yeah, good assessment. What about PolyNovo?
So PolyNovo is in the area of wound care as well as burn. So basically it's a material that you put on a wound or a burn, and it self-absorbs, so you don't have to get rid of stitches or you don't have to get rid of the material again. So look, they've been seeing good growth. The shares have been doing extremely well, and I really like the story. I do think that this is a story that still has much longer to run. So I think that PolyNovo is early in terms of its journey to growth. But I also think that valuations have probably got a little bit ahead of itself at this point in time. I think it's exciting that they are working on other products with their technology as well. So they are looking at things in the area of hernias as well as in the area of breast implants, which might open up a new revenue stream as well. So look, this is one I'd keep an eye on. I'd probably wait for a pullback before I got involved in this one, but it's a very good product with good sales at the moment and a good take-up, and very early on in its growth journey.
One last one, Nanosonics.
Well, this one is one that's not looking too crash hot. The share price has declined quite substantially, and that's because there is a lot of uncertainty. Now, Nanosonics at its core is involved in Trifon, which looks at cleaning ultrasound probes and things like that, and it's a machine. And what we've found during COVID-19 is the world has moved away from sort of machine cleaning into more spray cleaning. So I guess it's on the back foot here, but it's also been disrupted because of COVID-19 as well. Now, the market had been looking to a new product launch in the next financial year, but that's been pulled back to FY22. So look, that's another negative on the plate of Nanosonics here. The only thing is that the pullback has been quite severe. So look, it is looking interesting here, but it's extremely high risk. So it is a speculative play. And at the moment, if you're balancing the risks versus the opportunity, well, the risks are relatively high here at the moment. So if you're a bit of a risk taker, the pullback, I think, has been too severe. But if you're looking at something more reliable, then this is highly speculative.
So Julia, what's the stock you've liked the most this week?
This week? Well, we're involved in CSR and Boral, and they're both on to a good footing this week. And that's really because we haven't seen the hard landing in terms of housing here in Australia. In fact, it's been an extremely soft landing, and it looks like the housing market is starting to see a bit of strength come through as well. And both of these companies are exposed to the Aussie housing market. The renovations market has been pretty strong for CSR, given that anyone who does have a job, well, they're not spending on travel at the moment, so their household budget is probably in a good place. And we've also seen home loan data, which has seen a bit of strength coming back to the market. So look, I think the domestic housing market, together with some of the government incentives, is looking pretty good here at the moment. And usually we see James Hardie outperforming because the US housing market is stronger than here in Australia. But this week we've seen the opposite, where it's been the domestic East Coast housing companies that have been outperforming, and James Hardie, while it's been doing well, has been underperforming.
Julia, thanks for joining us.
Thanks, Pete.
Last week I caught up with the leaders of two of our top listed companies, the CEO of JB Hi-Fi, Richard Murray, and the MD of Webjet, Zhong Guscic. Now JB has killed them in terms of sales and profits as we spent up big in the lockdown and the closure of the economy. We're still doing the same because we're not able to holiday because of closed borders, and that's helped a business like JB Hi-Fi. However, Webjet is still grounded as a business, but it is showing some signs of taking off. At a low, the share price was $2.39 after being over $12 before the coronavirus came to town. It is now $3.54. But Guscic was heartened by the market's response to his capital raising, which was oversubscribed. This is what he had to say.
It was very heartening. It was one of the things that we took away from the exercise, took away from the process, was that there were many people who knew the plight, and we hired bankers to go through and help us with extending the story to the investment community. And most people didn't want to see us fail. And obviously in the end, when we did complete the raising, it was substantially oversubscribed, and there were a sense of relief, but there was also from our side, but a sense from the investment community that it would have been a shame that Webjet, which had been a successful Australian business that had taken its wares offshore and been successful internationally. And, I'll hark back to the 2019 results. 60% of our EBITDA was for a business that we started up only 6 years ago. So it was one where there was a sense of relief. There was a sense of expectation that we could continue our growth story once the pandemic had subsided. And there was great support across the broader investment community. And we've seen that continuously over, the bond note that we raised in July in addition, and then the support and the feedback that we've had from our investors has been, it would be almost overwhelming how positive they've been about the business over that journey.
Apart from the fact that, it's a great joy of life for me to be able to, talk to you, there is actually a monetary reason why I've got you here, and I want to ask a few questions on behalf of my beloved viewers that will actually help us understand where your company's going. First question, how important is the Australian domestic travel market to your bottom line? Give us some sort of percentage.
Sure. So we have three divisions, and one is the Webbeds B2B business, which accounts for about 60% of our profit. And we have the Webjet OTA business, which is impacted by the closure of international borders in Australia and the closure of domestic borders. The way our business is carved out in that in the OTA business, the brand that most of your viewers will know us by, the one that you see on TV and on billboards, etc., is that we have 85% of our volume is domestic bookings and 15% are international bookings. And by revenue and TTV, 65% is domestic and 35% is international. So in the current environment where domestic bookings are a fraction of what they used to be and international bookings are virtually non-existent, we're in a scenario where if we get to 23% of our previous volumes, we will be profitable in that division. At the moment, we're tracking at around about 16%, so we're sort of 2/3 of the way there. We're extremely optimistic that once one of the borders, either New South Wales to Queensland or New South Wales to Victoria, opens, that we get to at least break even, and when two of the borders open, we'll be profitable again. One of the things that is important for investors to note about our business since we last spoke is that the consequence of the pandemic has meant that we've taken a significant amount of costs out of our business, and therefore our break-even and profitability numbers are much lower than they used to be. So the scalability on the upside is quite considerable at this point in time.
Like Guscic, Richard Murray has had to pivot and work hard to run JB Hi-Fi in very changed circumstances, but his company is flying high. It started the COVID-19 era as a $43 stock, fell to $24 at the worst of the crash of the stock market because of the coronavirus, and is now close to $48. I asked Richard what would be his innovative strategy to keep the share price going forward. Because you're a chartered accountant, and gee, you don't look like one, you look like a normal person at this point in time, Richard. Well done, you. When your share price was around the 30s, inexplicably the market went against you and you dropped down to the low 20s, and now you're ripped into the 40s. I must admit, I haven't checked you lately. Where are you nowadays?
I think we're about $48 today.
Yes, I thought around 50. So my question is, and I know this is not your job to explain what the share price might do, but you've done it before, you defied your critics and you've grown the business. What's going to be the big strategy going forward so we eventually see, well, let me pick a price, not you, $60. What's going to be JB Hi-Fi's innovative strategy going forward?
So, I mean, you and I could get lost in price to earnings ratios. I guess if you just focus on how do I grow the profitability of the business over the medium term, and we assume the rest takes care of itself.
Yeah.
If I think about that, it is one, we absolutely have to do everything in the eye of the customer. And so we can't, but that can't be a blank check. So we do have it, while we want to delight customers every day, we need to do that in a financially sensible way. So we work hard with suppliers to make sure that we've got great promotions. We spend a lot less on advertising than most of our competitors, which means we can make sure our prices stay low. But fundamentally, and one of the things I'm really proud of is we actually have a pretty relatively generous internal reward program for the staff. And I think that means we retain the A team for our customers because they want to be served by knowledgeable people. And so if we're very focused, look after your staff, they'll look after your customers, and that'll look after your shareholders.
What's the future of retail? Obviously, things are changing as a consequence of the coronavirus. It's probably sped up a lot of changes. What's going to happen to retail, shopping centres and stuff like that? What do you think is going to happen, Richard?
Well, I certainly think that, I mean, we've got a lot of partners that are shopping centres that are very important to us. So I want to be sort of careful how I say this.
Yeah.
The harsh reality is some of the rents in shopping centres are hard for retailers to sustain, and it'll be interesting to see how that plays out. I'll leave others to judge it, but I certainly think for a lot of smaller retailers, those rents are not particularly sustainable. For us, I think as a mini major, we obviously attract a lot of traffic to a shopping centre, so we get a reasonably competitive rent. But I don't think most retailers at the moment think they'll have more stores in the future. Now, the argument for us is, do you have less bigger stores? Do you have less smaller stores? Or do you say, I can get more infill stores? But the reality is, I'm absolutely convinced JB and the good guys across Australia will have circa 300 stores. Because they enable so many things. They not just customers. How have we delighted customers during a pandemic? Because we have 300 warehouses across the country that we can deliver from, and are within about 11 kilometres of most customers. Whereas if we had one warehouse in Melbourne and one warehouse in Sydney, it's just harder. I'm not saying it's wrong, it's just harder.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
So last week on the Peter Credlin program, I was asked by Peter if I thought the recession was over. And I actually said, well, technically it looks like it is. And before I could actually get more out, my old colleague Terry McCann ripped in by saying, no. And before I could even say, well, what we're talking about, Terry, Peter said, well, time out. So I have to pursue this debate, which I'm sure Terry and I are going to have. And I'd love to know why he said, no. So Terry, take it away.
Peter, good to catch up with you. We were ambushed by the Queenslanders, but I think we had about 47 and a half seconds to talk about all the issues in the economy on the program with Peter. And because of the Queensland election and the debate they had on Sky. Well, what I was just saying no to was that I was struck by the fact that Guy Debelle was appearing before Senate estimates, and he was universally reported as claiming or saying that the recession was over. All the headlines said recession over. And I was really making 2 points. One, that in my response very briefly to you, but I followed it up with the column in the Australian on the weekend, that one, he didn't say the recession was over. What he was saying was that in the September quarter, we'd had a positive growth rate for GDP, whereas previously the Reserve Bank thought it might be negative. And I made the point fairly at length in the Australian that if the Reserve Bank wanted to announce that the recession was over, they would say those words, the recession is over. And my more substantive point was that it's not over, that we're still, we've had a bounce in the September quarter, but we're still way below where we were at the beginning of the year. And the economy is still grossly underperforming. We've still got something like 2 million people either officially jobless or effectively jobless. We've still got tens of thousands of businesses which are either shuttered permanently or shuttered temporarily. And we've still got more than 3 million people and their businesses that are being held up by JobKeeper. So, we're very still, the idea, and I was reacting primarily to the idea that, happy days, we hear again, we could all, start holding parties because the economy was booming. That was what I was primarily responding to.
Yeah, because see, you know yourself, and I do, and I was going to say technically we are moving out of recession because you get yourself a positive quarter. The December quarter, Terry, I think will be another positive, but yeah. And basically the point is that you're making is okay. We might be not going backwards like we were before, but we're a long way away from where we were before the coronavirus came to town.
And then again, in addition to that, Peter, we've missed out on what should have been growth in the economy through the year. So it's not just we haven't got back to where we were in the March quarter. We certainly haven't got back to where in a normal year we would be in the December quarter or indeed in the March quarter next year. The thing about this recession, which is sort of, everybody obviously understands it, but it sort of gets pushed aside, and that is that it's the weirdest recession we've ever had because it is one that has been directly ordered by the government. The government has ordered businesses not to function, and the government has ordered people to lose their jobs. We've never seen anything like this before. But it's very important, Peter, as you'd appreciate, because until the government orders those businesses to function again, orders those businesses to be able to employ people, and I'm thinking obviously particularly of tourism, I'm thinking of hospitality, I'm thinking of air traffic, I'm thinking of a whole range of businesses. We certainly can't get back to a normally functioning economy or society, but we can't get back to an economy which is not in a forced lockdown. And I'm talking about the economy rather than the people.
Terry, I know it's a very risky question for me to ask you this because after all your years of analysing the economy, in national newspapers and various media, my own personal feeling is I've never felt more insecure about reading the data because I've never seen such a crazy period where the level of government interference is extraordinary. The size of the deficit is beyond what you and I would ever thought was imaginable. And as you pointed out, the government basically has instructed that the economy go into a recession for health reasons. My question to you is, how confident can you be about any prediction that you make going forward about what the economy might do in 2021? Because we hope it's going to be better than 2020, but to what extent can you be reliable in your belief about what the economy can do in 2021?
Well, Peter, I tend not to be in the prediction business at the best of times. I feel very strongly that the future is unpredictable, but you're absolutely right. At this juncture, start with that fact. We've never had a situation before where a government has set out to deliberately destroy businesses and deliberately destroy jobs. And early in this piece, people were coining the term hibernation, as if we could all go to sleep for 3 months or 6 months, and then we'd all wake up and we'd all go back to where we were. Well, that was clearly insane, because it wasn't, there was so much damage done to businesses and so much damage done to jobs, individual jobs. The idea that they could all spring back miraculously was always going to be ridiculous. And secondly, we've got the virus. If anyone can tell me that yes, there'll be a vaccine in March, yes, there'll be a vaccine that will work, it'll be distributed widely across the world, and we can go back to having planes flying, we could go back to all that international connections, well, then I think we could start to talk more sensibly about what 2021 and beyond would do. But nobody can make that promise. And you look at what's happening in Europe now. If you just think about the numbers that are going to come out of Europe, we saw in the June quarter drops that were much bigger than we experienced. The UK economy dropped by 20%, as you know, in the June quarter. That's not an annualised figure. That's not like the way the US reports their data. That was 20%. That the economy was 80%, only travelling at 80% of its previous level. It sprang back in the September quarter, but now UK is going back into lockdown. And this is, I don't know, what is the 6th or 7th biggest economy in the world. And you've got the same thing in France. You've got the similar thing in Germany, perhaps not quite as severe. What happens to those countries come the new year? They're going into winter, they've got the virus raging and they're locking down. What happens to them in the March quarter next year? So we come back to this basic reality, Peter. If we keep the country cut off from the rest of the world, we can keep the virus under control. But there's a huge economic cost as a consequence of that. I guess once again, we're very lucky that the sort of exports that we have don't require that close consumer contact that you have for countries that have got more sophisticated and consumer-focused export. Putting our iron ore and our coal on big boats and saying goodbye, it's a nice way to earn billions of dollars of export income in this sort of world.
Terry, can the stock market take what's going to happen in relation to the lockdown in Europe, the possibility of Joe Biden being president? The stock market.
That's the question. It's less about what's happening in Europe. It's what happens on Tuesday night their time, Wednesday our time. We go back to 2016, and initially the market went down on the prospect of a Trump win because it was so unusual. But within a day, it started a run which went on for 3 years, and really only came to a halt in March with the virus. So I think there's a tendency to think that maybe Biden won't be such a big negative for the market. I think if Trump wins, clearly that would be a positive. I'd hesitate to say a positive, because I don't know that the market can go up another 10-20%, the US market. Mm-hmm. But the thing that's driving the market, Peter, again, is less the politics. It's all that massive liquidity and those zero interest rates. Yeah. Now, I think that whoever wins in the US, we're probably going to have to see much more stimulus, much more money printing, both from the government and from the Fed through the course of 2021. Now that'll be a big boost to the market, but for you and me, it's not a very healthy boost to the market. I mean, it's building a bubble, it's building prosperity on foundations of sand. And I've always felt, right back to 2010, we will eventually pay a price for all that liquidity.
Mm. Yeah, Terry, I think you're right. Going back to 2010 and all of the stimulus that was required to pull us out of the GFC. And I always thought the only way we could get out was by having a period of strong economic growth. And if you look at where the stock market got to just before the coronavirus came to town, the stock market was up about 37%, the US stock market, because, there's that Aussie stock market over that Trump era. But this virus has really changed the whole economic equation. So we're left with a lot of debt, and with not the kind of growth we really needed to get out of this debt problem that started back in 2008, 2009.
Well, exactly. And now we've joined it in Australia. I mean, we with the benefit of hindsight, we had a very good 2010s, and to some extent a very lucky 2010s, because we were able to embark on fiscal consolidation. We came into the virus with debt higher than we had after Peter Costello, but not at anything like the sort of debt that you see anywhere else in the world, apart from Norway. We've now joined it to some extent. I mean, we're going to come out of this. Well, when I say come out of it, because I don't actually see a budget surplus again in our lifetime. Mm-hmm. The debt will just keep rising in dollar terms. It may be, if we're lucky, we can start reducing it as a share of GDP. But we're going to, we know we're going to go to $1 trillion of debt, and it's not going to stop there. It'll be $1.5 trillion sometime in the mid-20s, and again, it's just going to keep going up. Now, getting back to your original point, Pete, that makes trying to predict things, certainly 3, 4, 5 years out, almost impossible.
Yeah. Terry, thanks for joining us on the program, mate.
Great to speak to you, Peter.
Well, Tuesday come Wednesday, we'll be finding out who is the new president of the USA. And joining me is Dr. Angel Zhong from RMIT, who has looked into the implications of new presidents and how you might trade the prospects of a new president. Angel, thanks for joining us.
My pleasure, and thanks for having me today.
Mate.
So, well, as someone who does research in finance, I'm not an expert in politics, so I cannot predict the winning party, but I can predict which stocks will win during the first 100 days following the inauguration of a new president.
And that's exactly what we're interested in. The first 100 days of a new president, what usually happens?
Well, the first 100 days following the inauguration of a new president is what we call a presidential honeymoon period. As early as President Roosevelt, who signed actually 76 bills into law during this period, this is a time when there will be substantial and concentrated policy change. And we find that our research finds that value stocks tend to do much better during this first 100-day period.
Okay, so value stocks have had a bad run for quite some time. Can you give us the classic sectors within the value stocks that do well?
Yes, definitely. For example, if you think about this in Australia, all those mining stocks that are mature, that have a lot of asset in place, would be value stocks.
Okay, all right. So can you talk about, are we talking about the Australian market as a consequence or the US market?
Because I guess the US market lead the road. So that this actually applies to both the US market and the Australian market.
Okay, so let's just be specific, because people watching this would love you to be specific. If you look at the various sectors that represent the value stocks, what are the standout sectors that you'd expect to do well in this period after the US election?
So I would say, for example, the the big farmers and the manufacturing firms. But so the other sector, I mean, the other extreme would be the growth firms. They are a good example would be the fintech firms. So the reason that value stocks do well is due to the high political uncertainty during this first 100-day period. The growth firms, such as, for example, the FANG stocks in the US and the WEG stocks in the Australia, would be the other side of this trading strategy.
So are you saying that the FANG and the WAC stocks could lose ground over this period?
Exactly. That's the prediction according to our research.
Yeah,
and so explain a bit of the rationale of why. Yeah.
So what you're really talking about is a rotation out of the stocks that have done really well this year into the ones that have been pretty well ignored for some time.
That's correct. So the reason is that, during this first 100-day period, and I think it's human nature that if you step into a leadership position, you want to implement a lot of change just to stamp your own mark. So that applies for new US president. And also the public and the media also view this first 100-day to assess the success of an administration. That is why we also see a lot of or higher legislative success rate during this first 100-day period, which means this period has a lot of substantial policy change, which induces high political uncertainty. So value firms are those that are inflexible to adapt to change because they are mature. They have a lot of fixed assets in place. As a result, investors penalize these stocks at the start of this first 100-day period. But as you reach the end of the period, when the uncertainty gradually resolves with the policy changes, value stocks will reverse and tend to do well.
Okay, let's talk through, if Biden wins, will a different group of stocks benefit and be penalized because of a Biden win?
So in terms of, did you refer to the value investing strategy or the share market in general?
Yeah, the share market in general.
The share market in general, yeah. So I would say that no matter how many techniques that we use, how many complicated techniques that we use to view the market, share price comes back to a function of the present value of future cash flows. I would say that there is a significant difference policy in terms of tax between Trump and Biden. So as you know, Biden would increase corporate tax. That means it will reduce company cash flows and it will deter investment. So in general, I would say there could be a negative reaction in the share market. But however, as you know, the share market is forward-looking. Given the recent polling results, the market have already priced in a Biden win. So if Biden wins, that wouldn't be a surprise. So I wouldn't foresee a significant movement in the share market in general.
So Angel, let me put you on the spot. And being an academic, you won't like this question, but I'm going to ask you anyway.
Yep.
If you're going to invest either in the Australian market or the US market, is there a standout stock that you like because of your analysis?
I wouldn't pick one stock. As an academic, I always diversify. So I will stick to my investment principle, which is I always diversify. I buy a range of stocks from different sectors.
Okay, but you don't have a classic value stock that you really like that maybe has been neglected for some time, and you're thinking it's time for this value stock to do well, and post the US election, it just might?
No, I wouldn't name a specific. Because I always, I encourage my students to diversify. In my class, so yep. I always tell them you need to diversify. You do not.
Okay. All right. So therefore, at least the concrete conclusion should be that don't expect the high tech stocks to have a good period after the US election. They might come again, but it's more likely to be the stocks that have been ignored in the past period.
Exactly. Yeah. So I would say that value stocks tend to do better during this presidential honeymoon period.
All right. Now I've got you here. Now, our banks have effectively become value stocks. Do you think our banks will do better as a consequence of the US election?
Yes, if Joe Biden wins.
Okay, right. I got you on something. Thanks very much, Angel. Thanks for joining us.
No problem. My pleasure.
Thank you. If you want to hear my full interview with Zhong Guscic, go to my podcast on www.switzer.com.au. And for my full interview with Richard Murray, this goes out on Wednesday in our podcast, so make sure you go to our website, www.switzer.com.au, look for the podcast, goes out Wednesday afternoon, definitely there by Thursday morning.